All of the reasons that people are bullish gold today are exactly what I heard in 2010 and 2011 in gold. In 2011, gold peaked out at roughly 2000, and it basically took a 45% haircut over a decade before it came back to where it started. Do we get something that severe? We might. Roughly 78% of people are bullish gold. To me, I look at that and say, you know what? Everybody that wants to buy gold probably has already bought gold. There's probably going to be a situation where we just kind of run out of buyers and prices start tumbling, stop orders start getting hit. And I think it gets ugly really fast, kind of like it did in 2011.
Welcome to the Rose Show podcast. Welcome. Today I'm here with Carley Garner. She is a commodity broker analyst for over 20 years. She's an author of several amazing futures and options books, and she's a contributor on The Street, Bloomberg, and Mad Money. Jim Cramer. Yes, Jim Cramer. Her charts are always showcased on there, and we love her charts. It's our second time meeting. So how you doing, Carley?
Good. Thanks for having me, man. 20 years sounds like a really long time. It doesn't feel that long, but holy smokes, two
Right?
decades.
Time flies. We're
It
so
does fly.
grateful to have you here today to talk about equities and commodities and trading these markets because lots has happened since we last met in 23. I think it's about 2 years since we met. Let's get started. First, I want us to get started with your tweet. I love your tweets. I think everyone should follow you on Twitter or X, whatever you want to call it. And you wrote this recently. If I learned anything during the financial crisis, it was that a person's net worth is just a number on paper unless you sell assets. In the end, cash is king. Please tell us about that.
Okay. Well, unfortunately, I learned this the hard way. As we've already discussed, I'm pretty old. I've been around for a little while. During the financial crisis, I was young going into the financial crisis. I had just started out in my career. I was just starting to make what I thought was, adult money, and I was excited. And I obviously put all kinds of money to work in the stock market, and I had homes, and I was building assets. And it never dawned on me that you can lose money too. I would just all I was thinking about was how much I could make. I wasn't focused on how much I can lose. And of course, being young and stupid, I you just don't think of risks. And so what I learned then was um, exactly what I said. Unless you actually sell something or hedge it or liquidate it, it's really just a number and it's not yours unless you keep it. And so I always remind myself, like especially like now we're near all-time highs in the stock market. If I'm in that habit of checking my account, I'm not talking about my trading account. I'm talking about an investment account long term that you really shouldn't touch much. If I start finding myself checking the balance of that every day, every week, because it's kind of fun, when things are going your way, I remind myself of what it felt like back in the early 2000s when things suddenly weren't as rosy as we thought they were, and asset prices basically collapsed. We were in a deflationary cycle, and there was nowhere to hide. And so I always remember that. Accordingly, I'm not suggesting that anybody do this. I'm not recommending anybody do this, but I found myself trimming my equity exposure here in the last couple of days to 10%. I'm not necessarily thinking the world's going to end. I'm not even really that bearish per se. I just think that all of the good news is priced into the markets and there's a lot more risk than reward. And at my age, I'm not willing to, just not willing to play that game. Or, if the market corrects, which I will say this, Donald Trump during his first administration, it was, his policies were seen as business friendly and the market reacted and the market rallied nicely. However, if you look back during that time, we had some really, really big corrections. And that's because all the good things that come with this administration, there's also some chaos and some uncertainty. And those tend to trigger a lot of volatility. So I'm hoping that I get some volatility that allows me to reallocate my portfolio to something a little more reasonable. But for now, I'm happy with just a small amount of money in the stock market, mostly treasuries, bonds, all duration. And if it runs without me, I'll live with it. If not, I'm there to buy when we get a big dip.
Love that. You bring such practicality to this. And I think with experience, it comes, you're more cautious and you're focused on risk management. And here we are seeing the market going. I think SPX is going to all-time highs very soon. It looks like it's ramping there right now. I think it's at 6130s. So it is time to be cautious, especially when you see a lot of screenshots of profits being taken all over Twitter. So that
Right.
is always concerning. Carley, I want to get your thoughts on the current market conditions. We see, with the ceasefire in the Middle East, and you being a commodities trading expert, you are on top of all those elements, what's going on geopolitically and in the economy. So, what are your thoughts on the current equities market? SPX, the Qs, Nasdaq, and the small and mid caps.
Right. So I'll focus on the S&P for starters. I do think like when I pull up weekly and monthly charts and I look at the big picture, obviously there's some momentum. And when we're looking at long-term trend lines, I do see pretty good potential for the S&P running up to somewhere around 6,500. We're just under 62 now, so we're talking another 300 points or so.
Wow.
I think that's probably likely, just because when markets go up, the ball's rolling in a certain direction and everyone jumps on board, and that's how it goes. Kind of fundamentals almost don't matter in those types of melt ups. And I think that's what we're experiencing. But a few things worry me. For starters, well, I'll also say this, kind of going back to our last conversation. 6,500 is where I see pretty good resistance. That's only 300 points away. But if something goes wrong, if there's a surprise, and we've had plenty of surprises this year, it's not uncommon. If there's a surprise, the downside is probably the low 5,000. So the way I look at it, if I'm fully invested, which obviously I'm not, I just mentioned that, but if I was, I'm trying to squeeze out 300-400 points maybe on the S&P, but I'm risking 1,000 or more. To me, that doesn't make sense. If I was 20 years old, I probably wouldn't pay attention. Just keep plugging money in and going on with my life. But I'm not 20. I'm old enough for it to matter. I don't want to delay my life because I get caught in some sort of, repeat of 2006, 2007. And again, we don't know if that's going to ever happen again, but the odds are eventually it will. I think we've been in a kind of a cycle of governments and central bankers like eliminating or mitigating recessions. But at some point, that's all going to catch up with us. I don't know when. Maybe it's tomorrow. Maybe it's 10 years. But I'm going to play it safe until we get to that point. So with that said, I think in this current market environment, I think there is some upside potential. Again, I'm not a pessimist. I think we've just probably priced in all the good news. And a lot of that comes with, since COVID, since the pandemic, governments have been very aggressive in printing money and stimulating economies and this and that. And I think we're still working that out of the system. And so until that completely works itself out, I won't be really comfortable being an aggressive bull in the stock market unless we're from much lower levels.
Very nice. Thank you for that. So we're always thinking in probabilities. And when we trade, we always look at the probabilities of win, lose, and it's always about the risk adjusted returns. And I like how you say that, this recession, and it's important that we have to look at the macro side as well. It seems to have been kicked off. The can's been kicked down the road. And at some
Mm-hmm.
point, I always say that we got to pay the piper. We had a lot of a huge money growth, and then now we have some contraction in the money growth, and we have still prices are elevated. And there's this talk about recession. It seems that it's going to happen. Some economists saying it's coming later this year, or maybe next year. Who knows? No one knows. Do
No one knows.
you believe that we're setting up for violent moves, potential violent moves in the SPX, meaning from an option trader's point of view, iron condors may not be the position right now with the range bound. We could be setting up for a violent move, like you said, maybe low 5,000s or 6,500. I mean, that's a pretty wide range.
It is. It's a massive range. It's really wild. So I will point out seasonality, like it used to be years ago, everyone used to say sell in May, go away. Well, that doesn't really work anymore, but selling late July, early August generally has been kind of the pattern. And we usually have a rough fall. So seasonality is going to start to get rocky here in the next couple of months. So that's something that's just something to keep in mind. And of course, we already mentioned there's all kinds of political uncertainty and risk. Some new headline that we can't even imagine today could hit tomorrow, and that changes things. I also worry not only are we up against some resistance, we're overvalued, but I worry that everybody is all in. Like if you look at some metrics and some studies, people are more invested or more allocated to stocks now than ever before. And on the opposite end, they're less allocated to treasuries, which are like the safety asset, than ever before. And that's just not a healthy environment for a long-standing bull market from these levels. Now, I'm not saying if we correct 20%, it's not going to be an amazing buying opportunity. It probably will be. But from here, I think it's a risky proposition. When everybody is thinking the exact same thing, which the majority of people are thinking stocks only go up, buy the dips, you can't go wrong. And that's worked for years. I mean, you can't blame them for thinking that. But I did live through a period where the S&P was pain and misery for 10 years. And those types of periods, they don't come around all the time, but they do come around. And one last thing I'll say, I always show this chart when I do seminars and presentations of the Nikkei, the Japanese stock index. It peaked out in like 1989, and we just now, like within the last 6 months, reached that peak. So it took them 3 decades basically to get that money back if they bought the highs from the euphoric rally. And I think it's fair to say what we're seeing in the US has been a euphoric rally. So it's not impossible. I'm not saying this is what's going to happen, but we have to just keep in the back of our mind that this has happened in history before. It's very possible if we're allocating money to stocks now, we might have to wait 10 years, 20 years, maybe even if something really wild happens, maybe even 30 years to get our money back. I know that's so inconceivable because of the experience we've had in the last 15 years, but it's not impossible. So just always keep it in the back of your mind.
Wise words. We know that from 2000 as well as 2009. It took quite some time to recover. And so it can definitely happen again. I mean, history tends to rhyme. So it's important. I really appreciate those words because those are really wise words. And we need to look at our history. You know, I want to talk about the Russell, the smaller, the mid caps. Do you believe that we're going to see some rotation into those and those start running? I mean, there's a lot of talk about rate cuts, and we could get something in July, maybe September. Some economists are saying that we don't even need to get the cuts. Just talking about them and expecting them is making the money flow to these smaller mid caps. Do you think that the IWM should see some appreciation? Are you bullish there?
I am. Like in the futures world, we trade the Russell. So it's the same idea though. And I do think that like if you were going to put a gun to my head and tell me you have to put money in stocks, pick somewhere to put them, I would probably go to small caps, and probably for a couple of reasons. The current administration, whether you agree or not, they've basically made everybody aware that their goal is to kind of shift money from the big players to the Main Street players. And a lot of that would basically be deregulation, lower interest rates, and those two things are going to be very beneficial for small cap stocks. And even more importantly, small businesses, which aren't represented in that, but that's going to be the idea. And they've said it publicly, so I wouldn't bet against that. I think that's probably what's going to happen. And just the deregulation itself is going to take a lot of pressure off of those smaller players. And I think that too is a reason to be a little overweight small caps relative to, the last couple of years. It's all been about 5 or 6 tech stocks running along. I don't think that world is going to exist here in the next couple of years. I think it's going to kind of shift towards small caps. But again, small caps are known for being the most volatile sector of the stock market. So you don't want to put all your eggs in one basket. But I think in this day and age, what we've seen historically is, particularly like in my business, what I've noticed is the sectors or the markets or the commodities, whatever it is, that outperform in any particular year or 2 years, underperform the next couple. Like it's a never-ending cycle of underperformance and overperformance. So if you pick the sector that hasn't done so well, eventually they're going to get the tailwind and it's going to go their way. And I think that's probably the scenario we're going to be looking at in the next couple of years.
Absolutely. I tend to think that as well. So, yeah, good points there. So, any particular sectors that you are bullish or watching right now? A lot of future trades are going on right now. You have the autonomous driving, the
Yeah,
AI, obviously, aerospace, quantum. Any of those are very speculative. Any of those of interest to
right.
you?
So I don't follow the stock trades related to those stories, but I follow the commodity trades that are. And my personal opinion is the AI trade that encompasses all these different things is probably way overblown, at least for the current environment. I mean, it's not unlike in the late 90s, everybody knew the internet was going to change the world, but that didn't stop us from having a couple stock market, you know, I don't want to say crashes, but almost a crash in between before it all came to light. So even if AI is the big game changer everyone expects it to be, it doesn't necessarily mean that all of these plays that are working now are going to keep working for 10, 20 years while it all materializes. A couple of things in the commodity sector is copper's been a big beneficiary, and so is silver. And believe it or not, it's kind of an unpopular opinion, but we're bearish and well, let me clarify. I don't touch silver. I watch silver
Mhm.
to help me speculate in other stuff. I would never trade silver. It's just the most awful market I could ever think of.
Mhm.
It's volatile. The margins are high. It's just not the place for most people to be. But it gives us some clues on things. Copper, on the other hand, is a little more reasonable, a little more civilized, and we actually put on a bearish copper trade today. So
Mhm.
our idea is all of these things are already priced in, they're known, everybody's on the bandwagon. But when everybody's thinking the same thing, somebody's not thinking. That's my opinion. So I
Mhm.
think that we're probably in a situation where these trades are overcrowded and they probably roll back. And if that happens, I'd say we probably see precious metals and industrial metals peak out here in the next couple of weeks and start experiencing very significant corrections, in my opinion.
Well said. Well, I want to get into commodities, and I think that's the perfect segue into the commodities. And we'll talk about the metals and oil. And I know you and I are not gold bugs, and definitely not a silver bug, if there's even such term as that. But before we get into the market conditions for commodities, I want to make an important point, and I know you make the same point, how trading commodities is vastly different than trading equities. And I want to talk about the speculation. And I know you do futures trading, but commodities are driven by many exogenous factors, and weather being one of them with the wheat and corn and all the ag stuff. But also, you watch the geopolitical events and the economy, and there's so much that goes into that. Please tell us, because there's no one better to tell us about the differences than you. Please tell us the differences.
Well, so for starters, I'll start with this. Like in the world of investing or in stocks, generally, I mean, unless we're talking about pink slips or some weird, stuff, the stock market generally moves together and it generally moves higher over throughout time. Like if you're trading the let's just take S&P 500, over time it consistently moves higher. We may have a decade where it goes nowhere or whatever, like we mentioned, but you can almost always expect if you take a 30-year period, they're going to go higher. Commodities are the exact opposite. Commodities don't only do they not go higher, they actually spend more time going lower than going higher. So the problem is a lot of new speculators come to commodities and they only want to be on the buy side, and I can understand that because the theory is a commodity can go to zero but can't go below zero. So if you're a buyer, you kind of have limited risk, although it doesn't really work that way, but that's what's in their mind. And if you're a seller, there's unlimited risk, so they're scared. But the reality is, it goes if you sold commodities on every rally and you had enough money and enough fortitude to hold the position, you'd basically never lose because commodities rally sharply, but they always come back down. They always give it back and even a little more. And the reason being, renewable commodities are like we get better at growing or extracting commodities every year. So technology is deflationary. And so it's just kind of a different mindset. A lot of people have this mindset of investing. They want to buy corn or buy crude oil and just hold forever. And that's really not how it works. It's a more trader's environment. You have to be willing to take profits and move to the sidelines if you're a long trader and be patient and wait for prices to get down to relatively low levels. And it's just a different animal for most people. Also, the market the commodity market, if you're trading futures, not ETFs, it involves leverage. And not everybody understands how leverage works. And the vast majority of people don't appreciate how dangerous leverage can be if you're not minding your risk or hedging and doing the proper things to control your risk.
So it's a trading market rather than an investing, a buy and
Right.
hold long term. Got it. That's a key, very important. And you need to avoid
Yes.
the over leveraging. So
Right.
okay, so let's get into these commodities. Let's talk first.
Okay.
Let's start off with oil because
Okay.
everyone's it's in the six. I think Brent is at was it crude is at 65, 66 some right now.
Right.
And they were talking about $100 oil again. And then I think you are one of the ones that also believes that there's a potential we can go in the 50s.
Right.
What are your
Yeah.
thoughts on oil right now, especially with all the
Mm.
geopolitical issues going on?
So if you take away everything going on in the Middle East right now, crude oil would probably still be in the mid to low 50s and maybe even headed lower. But obviously, that's the thing about crude oil is you just never know when the next bomb is going to drop, no pun intended,
Hmm.
and to change the trajectory of the market. But in this case, and in almost every case, when you see Middle East violence, the crude oil rallies are almost always temporary, and most of the time when it gives that rally back, it usually goes even lower than it was before because, as you can imagine, as prices spike, producers step on the gas and they get as much to the market as they possibly can, and then eventually kind of floods the market in the short run and prices go even lower than where they started. And I think that's exactly what's going to happen. It was a pretty good lesson for speculators the last couple of months actually on how commodities are to be traded via price action and sentiment and things like that, not necessarily fundamentals. Because nobody wanted to buy crude oil at 55, but suddenly after all of these Middle East headlines started coming out, everyone wanted to buy at 75, and that's the exact wrong move in commodities. If you're already reading the news about it, you're too late. In this case, you could see there was weeks before the bombs were ever dropped in Israel and Iran, crude oil started moving up, and it started moving up even despite OPEC increasing production. So things weren't making sense. I didn't know at the time. I was like, well, this doesn't make any sense to me, but markets are always right. And sure enough, the market must have known. Somebody in the market knew what was going to happen. We didn't know it, but the market knew it. So it's just a good reminder that fundamentals are late and price action is kind of where you see the story before it actually hits the airwaves. We saw something similar in gold. In February, gold broke out from a 10-year trend line. It went parabolic. It at the time, it was hard to justify exactly why. Like, what was the fundamental reason? No one really knew. And most of the buying was happening overnight during which told me it was overseas investors, not in US investors. So somebody knew what was going to go happen in April, May, June before the market. Well, I'm sorry, before we knew. So the market knew before we knew. So again, commodity trading is not a fundamental game. It's not studying the headlines or reading the Wall Street Journal. It's looking at price action, seeing where everybody's positioned, paying attention to what the driving factors are, not necessarily what the headlines are.
Perfect. So it's globally traded.
Yeah.
It's affected by supply and demand imbalances, and it often leads equities, right?
It can. The thing about commodities is they trade 23 hours per day. So, like you mentioned, people all around the world are trading it while people in the US are often sleeping. And they're able to react in real time to events that happened overseas while we were sleeping. So, you do see a lot of times commodities will make a move before the stock market gets to. Obviously, there are S&P 500 futures, NASDAQ futures that also react. But yeah, it's interesting to see how that works. In the case of gold and crude oil, I would say most often the overnight session kind of guides us, and usually the US session follows along and in with that theme. So, um, yeah, I would say you're probably right about that.
I like that. And they're deflationary, so that's another reason why you trade them. The prices tend to come down. Makes sense. And Carly, I'm just curious, are you up at 3 a.m. in the morning trading any of these commodities?
I'm not up trading, but I'm a broker, and so we have. Let me kind of explain how the business works a little bit. So
Tell us.
when people are trading futures, they can lose more than they have on deposit. So at our brokerage, we have a lot of clients. Some of them are full service and they're taking my advice and I'm helping them trade, but most of them are trading online on their own. So they have their mobile phone, they have their computer, or whatever it is that they're using to place trades, and they're buying and selling 23 hours a day on their own whim, which is fine. However, what becomes dangerous is when the markets are moving so quickly like that. It's very possible somebody that's over leveraged or just in the wrong place at the wrong time loses more than they have in their account. So for instance, to give you one example, a few years ago well, actually, I guess it was 5 years ago now, when COVID hit and crude oil went ballistic and eventually went negative and all that, we still talk about that 5 years later. We had one client that went on Friday's close. He had like $350,000 in his account. He was not on a margin call. He had plenty of margin excess. Everything was fine. But by Sunday night, when the market reopened, his $350,000 account was now negative $250,000. So $500,000 swing from Friday's close to Sunday's open. I'm not trying to scare people. I'm just showing you that's my reality. So when things are crazy, I'm up in the middle of the night helping clients manage risk to make sure they don't not only put themselves into bankruptcy, but put me out of business. So it's a challenge.
Oh, that's so nice. So they can trade at your brokerage at Carley Trading, right?
Correct. Yeah. These are DeCarley trading clients. Yeah. And we let people freely trade. I mean, as long as they're being responsible. But in the case of oil or sometimes gold, sometimes it's just beyond the scope of expectations. I mean, just in that particular oil instance, I think we gapped down $17 or something like that. So those types of things are very, very rare, but they can happen, and we have to account for that and just do our best to make sure everybody survives. That's the goal.
Absolutely. Thanks for sharing that example. Wow. What a swing there. Okay,
Yeah.
so you wrote a great article at The Street. I urge everyone to check out your articles on The Street. And it's a great title. Bombs dropped, so did oil. Are gold and silver next? Now, everyone's talking about gold and going 5,000, 6,000. They're saying it's of course they're talking about stagflation, they're talking about, devaluation of currency. What are your thoughts? Give us some reality check on the gold and silver.
So all of the reasons that people are bullish gold today are exactly what I heard in 2010 and 2011 in gold. In 2011, gold peaked out at roughly 2000, and it basically took a 45% haircut over a decade before it came back to where it started. Do we get something that severe? We might. I honestly, it would not shock me. I think gold's an interesting market because it's only valuable because humans put value on it, right? If you take our perception away, it's a rock. I think diamond producers kind of found this out when we started making diamonds in a lab, and everyone's like, hey, wait a minute, why do I need to pay X number of dollars for this when I can get the exact same thing, or at least something that looks like the same thing? So my point is, gold is just a perception of value. And I know it's been around for a long time, and I know people love it, and I know there's all these reasons to buy it. But in my opinion, gold is the kind of thing that you really only want to buy when nobody else wants it. When 75, 80% of the world, which is based on the polling that I've seen, roughly 78% of people are bullish gold. To me, I look at that and say, you know what? Everybody that wants to buy gold probably has already bought gold. There's probably going to be a situation where we just kind of run out of buyers and prices start tumbling, stop orders start getting hit. And I think it gets ugly really fast, kind of like it did in 2011. I also believe that it's kind of a cottage industry of people out there that have gotten in the habit of selling puts under these markets that seem to only go up. And it's just a matter of time. We're seeing the same thing in the stock market. People are selling S&P puts. It's just a matter of time until the market comes back and recaptures all of the premium that they've made over the last few years. That's just how it works. I'll also add, this is not something that most people are looking for, but I think the US dollar probably bottoms out between 97 and 95 on the dollar index that's traded on the ICE futures exchange. And I'm not just making that up. It's based on, I see what happened in Trump 1.0. Trump 2.0 is following the exact same path. And so I think that's probably what we see. is some sort of low in the dollar, especially if you think about the most fundamental thing about currency speculation and currency trading is the interest rate differential. Well, interest rates in the US are far higher than almost anywhere else, double or triple. Well, not triple, but let's say double than most places.
Mm-hmm.
So it makes absolutely no sense for people to be buying dollars and selling selling dollars and buying euro or any other currency that pays less interest. So I think it's just a matter of time between technical support, interest rate differential, and the fact that the Sell America trade that took place after the tariff fiasco kind of unwinds itself. I think we start going the other way and people realize, you know what, the dollar's probably the least dirty shirt in the hamper. It's probably the best place to be, even if it's not perfect. And I think we see the dollar go back up. That alone is going to pop the gold and silver bubble.
Exactly, because dollar and commodities tend to be inversely correlated. So right
Correct.
now we've had dollar coming down, and I think that short of the dollar is way crowded. And
Yeah.
we've had gold going up, over 3330s, I think right now,
Mm-hmm.
3300s around there. So,
Yeah.
okay, so are you actually shorting gold? Are you bearish gold? I know you're bearish
We are.
silver, you're bearish copper. Okay, you're bearish gold.
I'm bearish silver, but I won't touch it. That's just something to look at.
Okay.
We are actively today. We put on a fresh copper short, so we're doing that. We've been short gold. We actually exited the riskiest part of our position a few days ago. I think on Monday it was after the big sell off, and we're holding a put spread, so limited risk, but we are playing the downside. If gold rallies again, I'll have no hesitation to sell some calls and get back into a more aggressive stance there. So we are positioned on the downside in gold. One thing I forgot to mention about gold
Mhm.
is usually there's supposed to be a relationship between gold and treasuries because they're supposedly the two primary safety assets. Like when crap hits the fan, most people think most people look to buy either gold or treasuries as an alternative. And at the moment, we're just kind of off the charts crazy when you look at the spread between gold and treasuries. And the reason that matters is gold doesn't pay interest. So if you buy gold, you have price risk, no parachute, because if gold drops, there's no income cushioning your downside risk. But if you buy treasuries, sure, they can go a little lower. They probably won't go much lower, in my opinion. And even if they do, you're earning 4 or 5% a year to cushion that blow. So it doesn't make sense to put your money in an asset that doesn't earn interest when you can put it in an asset that will earn interest and maybe even give you some capital appreciation if things turn around. So that's something that for some reason everybody's ignoring. But
No, I think that's smart, keeping money in T-bills, because now we're actually getting something. I mean, we haven't for the longest
right.
time. I mean, now we're in the
Yeah.
fours, with T-bills. Even if we were in the threes, I mean, it's much better than we were, for the
Oh, for
recent
sure.
past, right? So it's a
Yeah. If Yeah, I was just to say, if you recall, and I'm sure you do, it wasn't that long ago, people were buying treasuries or T-bills or some securities around the world that were paying either zero interest or negative interest because their goal was, I just want to get my money back. I don't care if I make money on it. But now the same opportunity is presented to them where they can earn 3, 4, 5% and nobody wants it. It's totally crazy to me.
That's how it is. I mean, it seems like they didn't want gold when it was down, but now everyone seems to want
Right.
gold, right? You gotta try
Absolutely
to,
right.
right? And we gotta try to avoid the crowd.
Right.
And I like your thinking, Carly. Very smart. You are very
Thank you.
smart. So okay, bearish copper, bearish silver, but you don't touch it. Bearish gold. You're not bullish on oil. Um, what are you bullish on, may I ask?
We went long wheat futures today. Now we bought a put to protect it, so we have limited risk. But I don't know if any of your listeners follow wheat, but it's been a really wild ride. When Russia invaded Ukraine 3 years ago,
Hmm.
3.5 years ago, wheat went wild. It went from like $6 to 13, $14. It did it all at once. It was just a massive, just insanity. Well, everyone stopped looking at it because it started going down. But in the meantime, wheat's come all the way back down to $5. So it's basically 30% of what it was during the heyday during the war, the Ukraine war. But we're in a situation where now all the speculators are short. We're sitting on multi-year lows. A decade long, actually 20-year long trend line comes in. So we're right on support that's held for 20 years. Everybody's short, and the seasonal bottom is next week. So I'm going to give it a shot.
Very nice. It's almost like I tend to use the term reversion to the mean. It's like it goes one way and
Exactly.
then it comes back another way. It's
Yeah.
almost like back and forth. And now that it's so
Right.
low, it seems like an opportunity for a trade. I
Right.
like that thinking. How about live cattle, coffee, cocoa?
Cattle is an interesting one. So the cattle market is off of all-time highs, but not far off all-time highs. It's still wildly overbought for some reason. Like there's this there's a saying in commodities, high prices cure high prices. And it always works, no matter what. I've never seen it not work in a single commodity. Once prices get high, producers start producing more, consumers start pulling back, and then the price reverts back to a more equilibrium level. I believe it's going to happen in cattle, but for some crazy reason, it's held out longer than any other commodity I've ever seen. Like it's been up here roughly a couple of years, really. We've had a few pullbacks, but it just comes back. So it's been the most resilient commodity I've ever seen. But I think we're getting really, really close to the inevitable happening, and that's gravity coming in. The consumers, I don't know if you've shopped for steak, but if you go to Costco, like a pack of meat is like $80. That's totally insane. I started eating more chicken and pork because that's a lot of money. At some point, consumers are going to stop spending that kind of money for red meat. I don't know when it'll be, probably soon. But more importantly, what I think has allowed this market to behave unlike any commodity I've ever seen is the US government has an insurance program that they subsidize. So it's basically a way for cattle ranchers to get insurance on price protection. It doesn't insure them against loss of their cattle or any of that stuff. It's literally just a price protection insurance. It's almost like buying a put option, but the government's giving it to them on a discount. And the government's giving it to them without them having to put any money up front. They have to buy it after the fact. So it sounds to me like a lot of these ranchers are buying their government insurance, but not, I take it back, not buying it. They're just locking it in because they're making a phone call saying, I want this. They mark it down in their spreadsheet. Now it exists. Then they go out and buy the cattle. So the government is kind of, and what I'm trying to say is this government program, which I love cattle ranchers, most of them are very nice people, but the government is allowing this to run away. And at some point, it's not going to work. The math is going to have to math and things are going to have to come back into line. And I think it's going to be something that ends very poorly for everybody involved, probably including the government. I don't know who's holding the bag there, but I hope the government has someone hedging for them because if they don't, it's going to be really nasty.
There's always a bag holder, unfortunately.
Right.
Yeah. So, and I don't know if it must apply in commodities as well. Prices can remain more rational longer than you can remain solvent.
Yes,
So,
that's absolutely true, for
okay.
sure.
So live cattle included. Um, what about coffee and cocoa?
Cocoa, I'm not really going to touch because it's a market that's impossible to trade. We've tried, like, for example, I'll give you an example. A couple years ago, when cocoa first started making its run, it ran from like 2,000 to 8,000 very quickly in a very short amount of time. It's a thinner market. It's traded on the ICE exchange. So it's traded on an exchange that most people can't get data for because it's very expensive. The market hours are weird. They cater to overseas traders. So it's really just not a great place to trade. But we thought we saw an opportunity. And so we started buying puts. We bought put options, limited risk,
Mm,
not spending a lot of money, spending $900 per put with lots of time. And we thought we were pretty smart. But what we found out was even those puts that were in the right place at the right time, we couldn't sell them. The market dropped sharply. We'd look at our statements every night, and the exchange would say our put's worth this, and we're making this much money, but nobody would take the other side of our trade. We tried to liquidate, even taking 25% haircut, and no one would take it. So I just took it off my quote board. Not even going to try. That's an impossible market. Coffee, on the other hand, it's been really, really volatile. We've had some luck there. It's been wild ride. I'm not going to say it's been easy money, but uh, any other time coffee has gotten this out of hand on the upside, it's always given it all back. My projection for coffee is somewhere around 250. We're at about 3 right now. And to be honest, we're not 50 cents in this particular market is not that much. We started out at 430 just 3 or 4 weeks ago. This has been an insanely volatile market. I do think the pain trade is going to continue to be lower. The seasonal bottom is usually next month, but I feel like when coffee was rallying in December, January, I talked to a lot of producers, and a lot of producers were kind of, I don't want to offend anyone, but the mentality was, we deserve this. You know, we suffered for years. We weren't making enough money, and now the market's finally giving us what we deserve. And nobody wanted to hedge. And so when you have an environment where farmers and producers refuse to hedge because they think that the market owes them something, there's bound to be people caught on the wrong side of the sell-off. And I think that's exactly what's happening. So I suspect we go a little bit lower. I wouldn't be a seller down here. You've missed the easy money. But if we get to 250, maybe be a buyer. So we'll have to see how that goes.
Interesting. The market doesn't owe anyone anything. So
no, it doesn't.
Definitely.
The goal is to not let it take all your money. That's the goal.
That's the goal. Absolutely. I agree. And more. And in commodities, they could take your money and more. So we don't want that to happen. You know, you wrote a great article that says, beware these overcrowded agricultural trades. So which are the ones that are overcrowded?
So one we already talked about, actually, we've already talked about a few. So wheat was one of them. It's overcrowded on the short side. Speculators are very aggressively short wheat. So that's one. Let me explain this. When in commodities, because they trade sideways, they're not like a always inclining market like stocks are. I'm not saying they're easy to predict, because they're not, because you don't know how big the swings are going to be. But you can almost bet your bottom dollar, if everybody is on one side of the boat, it's only going to take something to tip it to the other side. So we look for overcrowded trades. We use the COT report. It's called the Commitment of Traders Report. It's issued by the CFTC. It's kind of complicated if you look at the government website, but I'll give you a life hack. Barchart.com has Commitment of Traders charts. They're free. They're so easy. There's just lines in the bottom of the chart. Anyone can read them. They're fantastic. So basically the idea is, what we look for is large speculators. Are they too hot? Are they too long? Are they too short? And then we start looking for signs that maybe the market's going to turn. You don't want to just blindly follow that, but it's just one piece to the puzzle. So what we've noticed is everybody's short wheat. So that's one of them. Everybody, and I mean, everybody is long cattle. So that's the one we're still waiting for to break. And I think it will. It's just a matter of being patient. And the dollar index is the other one. That one's a little trickier because most of the people are doing it in options, not futures. But it's wildly overcrowded. Nobody thinks the dollar can possibly go up, which tells me it's probably going to go up soon.
Yes, makes sense there. Are you long the dollar yet? Are you watching it to go long?
So the dollar index is kind of difficult to trade because we tend to use options. And if we are buying futures, like in a perfect world, I would go long a dollar index futures and I would buy a put option, because I don't like to use stops. My experience has been you get stopped out and then it goes your way and then you're chasing it, and it's a mess.
Yep.
So I prefer to go long and then buy a put option. That way I have limited risk, but I'm still in the trade. If the dollar goes to zero, my put's protecting me, but I'm still in the trade. Suddenly, if the dollar reverses and goes back up, I'm still in. So I prefer to do it that way. With the dollar index, options are untradeable. So what we've done is we've gone to the euro. We're long euro puts, we're short euro calls. So if we're right about the dollar, the euro will come down, and that's how we're playing it.
That's nice, trading the pairs. So that's a good trade there. I like that. Okay, so another great article you wrote. This commodity market eerily resembles 2014. That's not a good sign for bulls. Okay, so let's break that down for people. Will you think that it can resemble that market? But I have to ask you, what happened in 2014 for us non-commodity people?
Sure. So that article you're referring to was talking about corn, specifically grains, but most specifically corn. And in 2014, we were coming off a very wild couple of years of rally. Not unlike what we've seen if you followed corn, you know, from like 2021 to 2023, we had some amazing rallies in corn. We've given almost all of that rally back. In 2014, we had a little bit of a bounce during the spring of 2014. I want to say February, March, April, somewhere in there. It bounced $1 from the lows after this massive, massive sell-off. Then once it reached that climax, it sold off again, and it went all the way down to the low $3 in corn. And we are kind of following the exact same pattern. We had a giant sell-off in corn coming off the massive rallies. Like corn was $8 a few years ago, and now we're trading around $4. So that dollar rally was nice this spring, but it's starting to melt down. And I think we probably are looking at 350-ish in corn. No, anyone that's in the farming business does not want to hear that, but I think that's the reality. Just like some of the, just like coffee producers were complacent, farmers and corn producers were also complacent. They were looking at, earlier this year, we were in low fives. And I spoke to a lot of farmers, and their mindset was, well, the cost of production isn't that far off. Almost like the market owes us at least the cost of production. And of course, markets can low cost of production. They don't care because consumers don't care. When we buy something in the store, we don't care what it costs to make. All we care is how useful is that to us and how much does it cost? And then that's how we do our analysis. So anyway, I think a lot of farmers, unfortunately, I wish it wasn't true, but I think a lot of them failed to hedge properly. And that's probably going to allow us to kind of for prices just to collapse into the $3. That doesn't mean we can't bounce here and there, but I think the ultimate target's going to be 350, somewhere in there, which is going to be hard for farmers to stomach, I'm sure.
Absolutely. And are you short corn futures?
Believe it or not, we're not. We had some short puts. We've pulled everything off. So we're just sitting flat here. I would love to see a nice rally to get back in, but if not, we'll just wait. Because at some point, we're around $4. So let's say I'm right and we do get down to 363. We'll be ready to buy with both hands. So that's kind of the plan.
Very nice. Okay, so Bitcoin. I want to go into, we talked about gold, talked about the dollar, and now another alternative currency or reserve asset, Bitcoin.
Right.
What are your thoughts on Bitcoin? 2 years ago when we met, you said it could go down much further. I think you even said maybe go to zero. You said very low.
Yeah.
You said you weren't bullish on Bitcoin. Are you bullish Bitcoin here, or what are your thoughts?
To be honest, the whole Bitcoin thing is, can it go up? Yes. Would I buy it? No. It's not my asset class. It's not something that I'm confident in. I still kind of maintain the same mentality in that I think blockchain technology is probably going to be around and I think it's going to be useful, but is it going to be particularly that one coin that does it for us? I don't know. I don't think so, but I'm not an expert in that. So I'm sure someone has much smarter things to say about that. All I will say is it's a market that trades 24 hours a day, very lightly regulated, if any, and really dangerous things can happen there. So it's not where I wouldn't put my money there. I know that people have made lots of money, and I've watched them on the sidelines, a little bit jealous actually, but it's not for me. So I wouldn't be surprised if it went to zero. I'm not saying it is, but it wouldn't shock me. I think, let me put it this way. Every family member that I talk to that has never mentioned investments to me ever in their life, they've never mentioned anything about markets. They always ask me about Bitcoin. And to me, that's just such a weird dynamic. And I think it's a kind of a house of cards. So I'll just leave it at that.
Yeah. Thank you for that. I appreciate your input. You're a real assets kind of person, it seems. Commodities, and you can't get any realer than that. So I want to talk about tariffs. Tariffs affect commodities. They affect everything. So what are your thoughts on the tariffs? A lot of people say that this is a negotiation weapon. They're not going to be as high as Trump has been speaking about. But what are your thoughts on the inflationary element? Are they a one-up? Do you think they're inflationary? And how do you think they'll affect the commodities?
Well, we don't have a lot of guidance on this. It's all kind of new territory, but I can say when the last time Trump was in office, he did implement tariffs on certain products. And for the most part, those I mean, there's a few here and there, but like, for example, steel and aluminum, those sorts of things, the price of those there really wasn't a lot of inflation. All the parties and transactions kind of absorbed a little bit, and it might have changed the price a couple percentage points. So it wasn't a game changer either way. I personally don't think the tariffs are inflationary for one reason only. Consumers have choices. We don't have to buy the same quantity and the exact same products that we bought before. If tariffs come into play and suddenly some other products are a better value, or we decide we don't need 10 shirts, we only need 4, I think consumers just adjust accordingly. And again, I think everybody on the supply chain absorbs a little bit of it. So I don't think it's really as devastating as some people believe it will be. I don't think it's inflationary. I actually think it's deflationary. And the reason I say that is it does, for certain businesses, it kind of forces them or encourages them to tap the brakes on investments and operations and things like that. So I do think it actually pulls money out of the economy temporarily while people wait to see what's going to happen. And that in itself is deflationary.
I like that. I agree with that. Elasticity of goods, very important.
Right.
There's always replacements. Only a few things are really not replaceable. But yeah, it's about when you see those prices go up, you get that one up, you cut back or you find a replacement. P times Q equals total revenue. And I think we're going to see that come down. And I do think we're going to have deflationary forces coming up ahead. So yeah, I'm in that same camp. Okay, so we got that special treat for everyone. I'm so excited. We love to see your charts. Your
Okay.
charts are something
Let's do
very special. And Jim Cramer showcases them. You've been on his show many times, and I've watched it. I'm sure our people have watched it, and we love your charts. They're special. They're different than just the basic charts that you see. They're very complex, and you have a lot of lines on there. So I would love it if you could share your charts with us and just walk us through for the audio only people, if you could just discuss what you're seeing on these charts.
Absolutely. So first I'll say, if you put enough lines on the chart, something's going to work, right? All right. So this is a very, very long-term look at crude oil. It starts in 2004. It's a monthly chart. And you can see there's a lot going on here, obviously. But one thing I would like to, if we pay attention to anything, I think it should be this. The rally that we saw over the last couple of weeks on all the Middle Eastern turmoil came right here, and it stopped exactly on the downtrend line. This line has basically held all of the rallies intact since peaking out in 2022. So while everybody's kind of the assumption that maybe $65 is cheap and that's as low as we go, I don't think that's the case, because we consistently have been making lower lows on each of these rallies. And every time we've rallied, we pay attention to the COT report, as I mentioned. Every time we've had these rallies, speculators get less and less long. So there's less enthusiasm behind them, and we keep making lower lows. That's not a recipe for a bull market. Now, maybe if the ceasefire agreement fails and we get really crazy in the Middle East, maybe I'm wrong, and maybe we do see much higher, but I don't think that's going to be the case. I think we're coming down to this line, and there's some guessing here that comes into this support line. This is kind of like a second tier. This is what I consider kind of a new environment. The drill baby drill environment, I think, is going to be, we shift all the rallies and all the basically the trading range, I'll put it that way, basically shifts the trading range a little bit lower. The US is a big producer, and you take regulations off the table, or at least minimize them. And I think they're not going to be shut up producing. I do hear a lot of people talk about cost of production, and we can't possibly go below cost of production, but there's something to keep in mind. US shale cost of production is probably somewhere in the mid 50s. There's all kinds of different variables. Offshore is a little lower than that, but there are some Middle Eastern countries that can produce for $20, $25 a barrel. So just because our cost is 50 doesn't mean somebody somewhere else can't produce it a lot less. So we have to keep our mind open to the reality that we could easily go lower. In fact, I think we probably do. Let me take a,
It looks like a supply and demand chart. I love the lines. It looks like, reminds me of the supply and demand charts in economics. Then you have a
it,
shift in the line right here with where the next line could be. Interesting,
right.
interesting stuff. So it looks like
Yeah.
oil is very good probability of coming down lower into the
I
50.
I believe so. I mean, I will say, you want to be very careful being an oil bear. Basically, sell rallies. You don't want to try to sell into the hole. That's just that's a tough place to be. But any large rally is probably a good place to dig in if you're a bear. Just two more things before I move on to gold.
Yes.
This line here, this is $65 a barrel, and it is very pivotal. Any time that we've been below $65 a barrel, we've seen massive sell-offs into the 20s, 30s, or in 2020, it went to zero. So uh, below 65 is very dangerous for bulls. Right now, we're kind of hovering right around 66, 65. The market's trying to figure out where to go. If we fall below 65 again, I think it's going to be lights out, I should say, for the bulls, but we'll have to just kind of monitor that. And to give you an idea where we are, we came into this week short calls and long put spreads, so we were pretty aggressive with our short position. As of now, we've bought back all of our calls and we're holding put spreads. So we're not willing to have unlimited risk at these levels. If we rally sharply again, we will. But for here, we're holding put spreads, which is limited risk and positioned on the downside, but not going to ruin our lives if it doesn't happen.
Mm-hmm. Got it.
All right, let's take a look at gold. Whoops. Sorry, I'm going to have to just.
Oh, please take your time.
Okay.
Gold monthly. Wow.
All right, so this is a monthly chart of gold. And I think earlier I referenced, I think this is a repeat of 2011. And you can see 2005 through 2011, we had a really nice rally. It went parabolic at the end.
Mm-hmm.
And once it ended, it just got ugly for at least a decade before.
Wow, it took
I
a
guess it
long
started
time to
around.
come back to that same point. Look at that.
It
Wow.
did. Yeah. It took about a decade to
Mm-hmm.
regain. So only time will tell what happens from here, but I think there's a really good probability we get the same thing. You can see I use RSI, which is relative strength, and this is a monthly chart. So when you're using oscillators on a monthly chart, you don't really get overbought or oversold very often. You can see this is a 20-year chart and we've only been overbought 4 times. So, and you can also see the rally has really never survived. Like we've tried, but you always get a pretty big correction. This correction looks tiny because we have so much volatility and prices are so high here. But this was I think it's about a 20%, 25% correction. So you can get a really substantial correction, even if I'm wrong and this market's going up. We can correct all the way down to 2000 in gold and not negate the uptrend. That's what's so crazy.
Wow.
And I would say if you ask somebody if they thought gold was going to 2000, they would think you were insane for even mentioning that. But this is exactly what we saw in 2011, the exact same thing. 45% haircut would put us right around here. And to be fair, it was only 2024 when we broke out above this level, which was about 2100. So it's not impossible to see a market give back a year's worth of gains before it continues higher. In fact, we just saw that in the stock market. These things happen. They don't send us a memo to tell us when it's going to happen, but they do happen, and it happens more than people think it's going to happen. So be careful if you're long gold. Make sure you take some off the table or, protect yourself, do something because it's not guaranteed to stay up here.
Mm-hmm. Got it.
Since we talked about cattle, let me show you what this looks like on a monthly chart. This
Wow.
one's been really wild. You can see up here we've colored outside of the lines for a couple of months, which is very unusual, but not, it's something that happens. In this market, I think we're repeating 2014. 2014 was the massive at the time, you see where it says tightest inventories since
Yeah.
1950. So in 2014, we had the tightest inventories since 1950. If you read any article on cattle today, you're going to read that exact same statement. This is the tightest inventory since 1950. But look what happened last time we were reading articles with that title. It didn't end well for the bulls. And I don't think it's going to end well for the bulls this time around. It's just taking a lot longer than I anticipated. I will
Mm,
admit sometimes, sometimes it's timing is very difficult.
I see.
But one thing I'll point out about cattle, which most people don't think about, anybody that's writing about the tight supplies in cattle, they're writing about per head, like per animal. But the animals today weigh a lot more than they did at any other point in history.
Mm,
Uh, probably 30-40% more than they did just in 2014. So even if we have the same type of tight inventory that we may be, in other words, let me put it this way, we might be short on cattle, but we may not be short on actual meat. And the market, for some reason, isn't recognizing that. So again, markets can stay irrational longer than
mm.
you can stay solvent.
Interesting. Would you say that demand has gone up for red meat? For
It has. And yeah, it had. Well, it's gone up, but it most importantly hasn't gone down despite prices. Usually when prices get high, people stop buying, and that just has not happened. You could argue, I mean, I know a lot of people are talking about the keto diet.
Yeah, and a
People
carnivore
are,
diet.
yes, yes. So I will say that probably is playing a part of it. Absolutely. So yeah, I mean,
Mhm.
maybe it'll persist. Maybe this is the one time that high prices don't cure high prices.
Yeah, maybe it'll stabilize at a higher level. I mean, who knows? Yeah, I've been reading a lot about the carnivore diet, and they're saying it's the most complete food. And for many
Yeah,
years they were talking about how bad red meat was, and now the narrative seems to be changing. So we'll have to watch
right.
and see. But interesting stuff.
Yeah, I'll show you one more unless you have a something you want to see. This is the dollar index, and I was
Yeah,
trying
I'd
to
love to see the
explain to
dollar. This is great.
yeah, so this is the dollar index future, and I was trying to explain this trend line. Like everybody thinks the dollar is in the dumps. Like everyone thinks the dollar's trash, right? Everyone you hear that
Yeah,
all the
total
time. The
trash.
dollar's worthless. The dollar's trading at 97. Okay, when I started in the business, we spent some time down in the 70s.
Hmm.
So the dollar is far from being cheap. In fact, it's still historically high. So I don't know where people get off using those words, but the reality is we have this trend line that started in 2006 and we broke a little below it during the financial crisis, but that was kind of a messy time. But for the most part, it's held it. And that trend line comes in at 95. There's kind of an internal pivot line. When Trump first came into office the last time around, we were trading in the same trading range, believe it or not. As he stepped into office, the dollar tried to break out and it failed and then sold off for the first year or so of his administration. And we're getting the exact same thing, the exact same trend line, reversed a false breakout, and we started selling off. So, assuming that we get a repeat of Trump 1.0, which so far it's been almost identical, it's been a little faster this time. But assuming that that's true, we probably bottom out around 97, and we're really, really close to that. If that's not the case, we break below to 95. That's not that far away. We're only talking 2 points in the dollar index. That's just basically noise. Between these two levels, there's a very high probability that we bottom out and start turning the other way. In fact, I think we go back up to 110, which is the top of the trading range. So it's not um, when you say that out loud, people think you're crazy. But if you look at the 20-year chart, it actually looks pretty logical.
Yeah, I see that upward trend line is intact. It's still, if you look at it going back to 2008, it's still going up. But yeah, it's not that low.
Yeah.
But what happens if rate cuts? Let's say we get rate cuts this year. They're factoring in, I think, at least 50, maybe more. What impact will that have on the dollar?
It's going to be interesting because so far, ironically, the fact that we haven't had rate cuts should be supportive of the dollar. Like
Exactly. Yeah.
based on interest rates alone, the dollar shouldn't have sold off, but it did for other reasons. So I don't know how the market's going to react to that. I think it might actually, it's going to be really weird, but I think it might actually um, be supportive of the dollar because it's kind of a
Yeah.
sign that things are normalizing and maybe people aren't as worried about the US fiscal situation and that sort of thing. So it's going to be very counter to what we would normally see, but I think that's
Mhm.
what's going to happen.
Interesting. Well, that's definitely one to watch. Could we see equities, like any SPX charts,
Yeah.
Russell? That we'd love that.
Yeah. So this, let me try to, okay.
Wow.
This is a weekly chart. Actually, let me go to a monthly. I think it'll be a
Hmm.
little neater. Okay.
Wow.
This is a monthly chart of the S&P. So I'm going to point something out real quick before we look
Hmm.
at the analysis. This bottom here, this is the 2009 financial crisis bottom, and you can see that we traded in this channel between the blue lines
Hmm.
for a long, long time, including just before COVID, and then eventually after COVID we broke out. In my opinion, if we wouldn't have been so aggressive to stimulate the economy and add money, we would have continued to trade in this blue trading range. And to put that in perspective, if we were doing that, the high end of the range would be 4,500. I'll resize this now that I've.
Hmm.
The high end of the range would be 4,500, and the low end would be like 3,500. So that, if that tells you how overvalued we are, that's the way I'm looking at it anyway. I know other people have other opinions, but I think we're just so far over our skis. That doesn't mean can't continue because our politicians have become very, very good at kicking the can down the road and expanding this scenario. So maybe it just keeps going. I don't know. But this is earlier I was talking about 6,500
Yes.
resistance, and this is where I'm getting it. If you take basically a decade long of trend lines, comes in at 6,500. And
Wow.
I do think we probably see it. But the reason I wouldn't be aggressively long is even if we see that, you start looking at the downside of this chart, 4,600 to 3,500. I'm not saying we're going to 3,500, but 5,000 to 4,600 is absolutely not impossible to see again. Trump, during Trump 1.0, and it's hard to see on this chart, but it's basically this time frame. He's kind of infamous for bull markets, right? Everybody enjoyed the stock market during his first term. But if you look at it, there's huge corrections. And I think I mentioned this before. So even if you didn't, well, let me put it this way. During the last time he was in office, we had a lot of opportunities to buy into very large dips. So I'm hoping we get a repeat of that. And if that's the case, those dips could be very big.
Very
Maybe
big dips.
1,500 to 1,000 points is not out of the question.
Wow. Now the 6,500, what type of timeline on your chart are you thinking could be the window for that? Do we melt up? Potential for melt up like many people
Mhm.
are talking, or do you think it's a
Yeah.
slower grind up?
Well, I think if 6,500 is seen, I think it'll be in the next month or two. So
Wow.
maybe even next week or two. So I don't think it's going to be far off. I think it just kind of marches on. Right now, we're not that far away. We're roughly 6,200. 300 points 10 years ago was a lot. 300 points in today's market is really not much at all. So I think it's probably something we see in the short run. And then again, like we talked about earlier, we start getting into seasonal weakness and we have political risk and who knows what could happen. And maybe nothing happens. I've seen, some analysts that I respect quite a bit are actually calling for melt up into the mid 7,000s. I'm not someone that thinks that's going to happen, but at the same time, I can't take it off the table because there is such markets haven't been paying attention to fundamentals. So why should they start now?
Right.
Maybe we do get that sort of thing. I wouldn't put my money on that sort of bet, but it's not impossible. And I've heard it from various people. So it could happen.
Interesting. Oh, could we see NASDAQ?
Sure. Sorry, that's kind of hard to squeeze all this in on
Mm.
this, but um, you can see this is a basically a 20-year chart, the
Mm-hmm.
monthly of the Nasdaq, and the basic gist of this is, most people aren't aware of, because there's a lot of market participants that are in their 20s or 30s. They've never experienced anything other than what we're seeing in the markets today, so they don't know what a normal market would be. But it took the Nasdaq 10 years to travel 10,000 points, or actually, this is 7,000 points. So it took us 10 years to travel 7,000 points. And then post COVID, we traveled 12,000 points in 20 months. Nothing about that is normal. But it's just the reality of too much money chasing too few assets, and that's what we get. So,
absolutely. Do you think we are in a high liquidity environment right now? A lot of economists are saying we have massive money contraction growth, and we're actually headed towards deflation based on that and a recession. Do you still see liquidity out there in your opinion?
the money supply took a few months off of growing, and it seems to be growing again. So I don't know. I don't think it's the same environment. I actually think that we're probably still working off this bazooka of stimulus that we got here.
I do too. I do too. I think
And
that.
yeah, and it could take several years to get that out of the system, to be honest. So,
I mean, we increased what, like 9 trillion, 5 to 10, 9, it was like so many trillion, what, 5 to 9 trillion,
right,
something like that. And it's going to take some time to work through the system with that
right.
money supply expansion that we had. So I
Agree.
am of the same thinking. Absolutely. So, wow. So where do you think NASDAQ, are we headed for also like SPX, some high numbers?
Yeah. So the Nasdaq really breaks a lot of rules. The S&P is a lot easier to chart. It respects trend lines a lot more than the Nasdaq does. Nasdaq's just kind of a wild animal. But I do use Bollinger Bands as well, and we're not too far off from the upper Bollinger Band in the Nasdaq. So I would say pretty similar to the S&P. Nasdaq's probably limited to somewhere around 23, 23.5. Um, Again, I wouldn't want to be long up here. Sure. Can it go up? Yes, but it would have to go up without me. I'm not willing to take that risk. This is a very similar setup. You can see the RSIs overbought here in 2021, 2022 when we corrected, and the Nasdaq went from 16,000 to 11,000. I don't think I think the correction in April was so fast and so quick, most people didn't feel any pain. So I don't think anyone has that on their bingo card, but I suspect at some point we have to do a repeat of this 2022 correction, and then that's probably going to put us down on this trend line again, this blue trend line, which is like 12,000. So we're talking about cutting it in half potentially. Again, I'm not predicting this. I'm saying it's not impossible. In fact, it's somewhat probable. So beware.
Probability of that. Wow, something to watch out for. And the Russell, I think that would be our last chart. That would be great to see these small caps.
I don't chart this one as closely. We don't have a lot of people that trade it too much, but I pay attention to it. You can see it's just not as pretty because it's not as liquid. But while the other indices obviously have been parabolic, this has gone basically nowhere. The highs in 2018 matched the lows of a few months ago, and we're not really not that far beyond that. So let's say this is a monthly chart, by the way, but it only goes back to 2017 because Russell futures kind of regrouped themselves a handful of years ago, 2018. So we don't really have data beyond that. But yeah, so I don't have any real great analysis on this, but from a fundamental standpoint and just from a risk reward standpoint, you could see, if you buy the Russell here and we happen to retest 2020 lows, it's not going to ruin your life. Where it would, like if we retested, can you imagine if we retested 2020 lows in the S&P? I mean, people would be committing suicide. That would just be awful. So I think if you're someone that's looking to invest new money, this is how I would look at it. I would probably be more inclined to put it in the Russell than anywhere else.
Yeah, absolutely. Oh, this has been a great show. I love this. These charts are beautiful charts.
Thank you
so much for sharing, Carley.
Of course.
Thank you for your time. Any other charts you want to show us or anything else that I missed?
I think we covered everything. I just clicked to this crude oil chart. I showed you the monthly chart. This is the daily chart just so you can see exactly where we are. The The 200-day moving average is exactly 66, 65, which is that pivot that I was mentioning. Nothing good happens for crude oil below 65, so that's something to really keep an eye on. Today's rally fell a little bit short of that, and that's not bullish. So if we start melting down the next couple of days, I'm not sure there's going to be anything to stop it until we get into the
What I
very low
read,
50s.
yeah, what I read across the top that really strikes me is we still believe this is a bear market rally. The
Yeah,
majority of Middle East conflict rallies fail. Wow,
yeah.
bold words.
Which is unfortunate because most people want to buy. Like my phone was ringing off the hook when crude was up here that everyone wanted to buy, and I tried to talk people out of it, but
Yeah.
people want to
And
do what they want to do.
they always want to buy when it's so
I
high,
know,
and then when it's down low,
I know,
they're not interested. No one wants to touch it, and then that's
I
when
know.
someone like you swoops in and says,
Yeah,
this looks enticing."
it's
Uh,
unfortunate. Markets are really mean. I'll just leave it at that. Markets are mean.
they're mean. They're very mean.
Hmm.
But you are very kind and nice for sharing your time with us, Carly. Please
Thank
tell
you.
our audience how they can follow you.
So you can follow me on X. The handle is at Carley Garner, Carley Garner. Here's our website right here in the middle of the page, decarleytrading.com. And I'm also on any of the other social media uh, platforms. So if X isn't your thing, you can find me anywhere. Just search my name and I'll come up.
Perfect. I see that. decarleytrading.com. Thank you so much for everything, Carly.
Thank you.
Thanks for enlightening us on commodities.
It was fun. Thank you.
Thanks.